The average American spends about a third of their life sleeping and about a third of their life working. That's a lot of time spent working. So with so much of our lives dedicated to earning money, it's essential for us to understand how we can make the most of the money that we actually earn. In other words, you work hard for your money. Let's make sure that your money is working hard for you and that you can avoid those things that can erode wealth over time. My name is Michael Sayre. I am a financial advisor here at CUI Wealth Management, and let's talk about some of the fundamental principles and concepts of finance. And this is one of many different videos that we've created to discuss financial principles. We'll cover some of the basics to help you make better decisions, but don't worry, we don't want to bore you to death with numbers or make you feel guilty about your coffee habit. We might do that a little bit here and there, but our focus and our aim is to help you make those small changes that can produce significant results over time. Personal finance is about making smarter decisions with the money that you have, choices that provide you with more freedom, less stress, and the ability to enjoy the things that you love without consistently worrying about the next bill. Concepts like budgeting might sound like they're about as exciting as watching paint dry, but hear me out. Without a solid grasp of financial fundamentals, we are prone to essentially fly blind, and while that might be getting us by, we can do much better. Some fundamental concepts we need to understand to optimize our financial situation is understanding personal financial basics, how investments work, have a clear vision of our retirement needs, and asset protection. We also need to look at estate planning. And a great place to start is talking about behavioral finance. Behavioral finance is a relatively new field that seeks to combine behavioral cognitive psychology and conventional economics and finance to kind of explain why people make irrational decisions about finances. Now, that sounds like a mouthful, and I know we said that we weren't going to bore you to death, but in short, it's figuring out why people make bad decisions with their finances. Here are 8 cognitive biases that can lead to poor financial outcomes. The first one is loss aversion. So the psychological and cognitive bias of loss aversion explains the tendency to avoid losses over acquiring equivalent gains. In other words, people are often more likely to be risk averse when it comes to potential losses than they are to be risk seeking when it comes to the possibility of gains. The pain of loss is believed to be twice as powerful as the pleasure that we get from the gains that we get in our investments. And this tendency can lead people to abstain from investing in the market simply because they're concerned that their investment may lose some value. Now, this bias can lead to suboptimal decision-making and investing. Next is anchoring bias. This bias occurs when individuals rely too much on the first information they receive about a certain subject matter, and they use that as an anchor for their decisions moving forward. Now, when we're shopping online, the first price that we see for an item that we're interested in sets an anchor for all the other comparisons after that when we're looking at prices. And actually, salespeople use this to their advantage often. They use this to influence customers to make a purchase. They'll show the customer a higher priced option for a product or service, which creates an anchor or a perceived value in the customer's mind. Then, when the customer is presented with lower priced options, this exercise tricks a customer into anchoring the value of the first price they saw so that the lower priced option appears to be a bargain. Next is the herding mentality or herding behavior. This behavior refers to the tendency of investors to follow the crowd even when they don't know if it's rational. So this behavior can lead to groupthink and fear of missing out. So this can cause market bubbles and crashes. People generally don't want to be missing out when there's a perception that everyone else is doing it, if they're following a particular trend, for example. They may think that others know something that they don't, and they don't want to miss out even if their knowledge on the subject is limited. So a good example of this is in the mid-1600s in Holland, there was a phenomenon called the Dutch tulip bulb market bubble. Now that's a mouthful, but really what it was is tulip bulbs were considered a symbol of wealth back in the day, and it was believed that any man of fortune should have a collection of them. And in fact, according to the Library of Economic Liberty, it was deemed a proof of bad taste in any man of fortune to be without a collection of tulips. The perceived value of tulip bulbs was due to the time it took to grow them, and some bulbs were rare and thus had more value attached to them. Everyone believed that the prices of tulip bulbs were only going to go up, which led people to buying them on credit, and they were hoping that they could sell that at a higher price and be able to repay their debt. The problem was when the tulip bulbs started to drop in price, people panicked and they sold the tulip bulbs at any cost, and the result was that people started to go bankrupt. Next is mental accounting. Mental accounting is the inclination of people to interpret and remember information in a way that confirms their pre-existing beliefs and ignores contradictory evidence. Now, that sounds like average person, right? Let me give you an example. So for example, an investor may hold on to a particular stock despite clear evidence that it is not performing well. And this may be because they have a personal attachment to the company that the stock is attached to. They may have held on to irrelevant information for many years, and maybe it was relevant in the time that they purchased it, but since then they've lost touch of the reality of how that investment is actually doing and how it currently stands. They ignore the facts that don't align with their beliefs. Next is risk aversion bias. This bias refers to people's tendency to choose options with known outcomes or lower perceived risk, even if the riskier option offers a higher expected return. One of the most common instances where we see this bias is when people decide to move everything to cash because they are concerned that the market is going to take a big downturn. They neglect the risk of inflation and the additional work that they're going to need to save for retirement in exchange for less potential volatility. Now, sometimes people hesitate to take on risks because they've experienced negative outcomes in the past. So for instance, they might have suffered a significant loss in their portfolio during a market slump. However, it's common for people to overlook the fact that they might currently be invested in something that's less risky or a less risky allocation than they did during the previous downturn. Next is hindsight bias. People tend to perceive events as more predictable after they occur. So for example, an investor may look back at their decision and feel that it's evident in hindsight when it actually wasn't. So we've all experienced conversations with our significant other where they say, I knew you were going to say that. I knew that you were going to say XYZ. And the truth is they had no idea what we were going to say, but they know us enough to see that as if they had predicted that we were going to say that, or that we were going to take certain actions. Hindsight bias can make us overconfident in our judgment based on available facts. And the problem is that we can oversimplify what's going on in the market. And this can lead to dangers when we use this overconfidence to try to predict the outcome of certain things when we don't have all the information. We may fall prey to hindsight bias and make inaccurate predictions if we perceive patterns that actually are not there. Next is the gambler's fallacy. This is a bias or belief that future random events are influenced by past events in some way that balances out the previous outcomes, even when there is no logical reason for such an influence. And I think the best example of this is if you are flipping a coin. You could flip a coin and have it land on tails 10 times in a row, and it's easy to think that just because it's landed on tails for 10 times in a row, that's going to have influence on the next coin flip. In reality, we still have a 50-50 chance of getting heads or tails, even though we have had a run of landing on tails for the last 10 coin flips. Investors can easily fall into this trap by relying on past performance when they're making investment decisions. So they may consider an investment's previous winnings or previous losings and see that as an influence on the performance moving forward. And I see this very commonly because sometimes what people do is they'll purchase an investment that has been performing really poorly, and they think that because it's been performing poorly over the last couple market cycles that it's going to go up at some point, that it's going to rebound. But in reality, that they may be overlooking other factors that could be influencing that investment. Perhaps it's the company isn't managed really well right now. Perhaps there are outside factors that are leading to the reason why that price of that investment has gone down. So we need to make sure that we take that bias into consideration. Next is the winner's curse. The winner's curse is when an investor pays more for an investment than it's actually worth. And this is usually due to a lack of awareness of the investment's intrinsic value, and the investor ends up outbidding others for that investment. A good example of this is an investor might be carried away when they're in a bidding war for a property, and they may pay much more than the property is actually worth. And in this situation, what happens is often all the bidders assume that their fellow bidders understand the value of the item or property they're bidding for. In reality, each bidder may be increasing their bid because of the influence of the other bidders that are trying to get that asset as well. It's really tough to control our internal biases and our behavioral tendencies towards ways of thinking about investments, but at least recognizing it is a great first step. Now, I hope this has been helpful. This is one of many other financial videos that we've put together, and so make sure that you join us next time. In the next video, we'll be talking about financial priorities, so make sure you listen in. If you've gained anything out of this, please like, comment, and subscribe, and don't hesitate to reach out to us if you have any questions or need anything. My name is Michael Sayre. I'm with CUI Wealth Management, and we'll see you next time.